$1.9 trillion worth of multifamily mortgages are set to come due and expire between now and the end of 2024. That is not a small figure. That's a massive number, and the implications are going to be huge, and we're already starting to see some of the effects come in the form of distress and foreclosure. You may remember Great Capital, we put out a research brief back in June outlining some of the potential risks. We've got an update to that report that is being released today as we are recording this, September 27th. Be able to go to greatcapitalllc.com/report to get that PDF of that research brief. Matt Bosnagel, Director of Communications and Marketing here at Great Capital, he's here to answer all of our questions regarding of what this means for the industry and giving us a little bit of a sneak peek. But more than that, we've got some great and really interesting articles. CBRE talking about the performance of older properties versus newer properties, looking at rent growth. Is one better? There's obviously two sides to the blade. We're going to be digging into that, but also Florida. What's the attractive? Why are some people so attracted to Florida? Is it the sunshine? Is it the low taxes? We're going to be looking at that, but then also looking at Minneapolis and why Minneapolis has struggled from multifamily performance perspective over the last several years. A little bit of tale of two different cities, different drivers. We're going to be zeroing in on supply. So if you're a multifamily investor, active, passive, anywhere that you might be interested, you're going to want to watch this whole episode. We go into some topics that are just essential if you were trying to navigate this interesting environment that we are in. So we're set. We got a full slate. Let's do it. Welcome back to the report.
Hello,
Dr. Matt Bosnagel. Thanks for being here again. How's your week?
it was good. It was really fun. You mentioned earlier at the top that we're finishing up the loan maturity report and some just running into some interesting ideas this week. Yeah. And I was able to follow up on some of the discussions that we had earlier on the Gray Report. So in terms of news, it was a wealth of really interesting information, and I had fun. I always have fun, but it was fun digging into and kind of testing out some of the theories that we had. Not the least of which are some of these theories about the loan maturity report.
Yeah, we've been talking about these loan maturities that are coming up in the multifamily industry, really through all commercial real estate, and honestly, there's loan maturities coming due across the economy. I mean, the federal government, among those next year, they've got a lot of debt coming due. It's a topic that has been just focused more and more frequently. Again, a lot of financial media doesn't cover multifamily or commercial real estate that closely. It's front and center. I'm also listening to folks at the Federal Reserve. Any economists are looking at commercial real estate kind of in the crosshairs as a potential catalyst for some macroeconomic distress. Matt, give us a little bit of the backstory. For listeners of the Gray Report, we've been talking about this for well over a year now, saying okay, this all happened, and just starting a really kind of simple connecting the dots of all of the transactions that took place, 2021 could end up poorly. Give us a little bit of the backstory for those that aren't familiar with the current situation. Yeah. What's going on? What are these loan maturities? So what's going on?
Just for like a really simplified study, and feel free to stop me if I'm leaving out important stuff. But I think you did isolate. Kind of began a little bit in 2021. Interest rates really low.
Yeah,
people buying more apartments than ever before. Part of the report has a graph shows clearly there's just this one golden quarter of 2021 where
I'll see if I can pull that up here,
where apartment sales were just far and away above anything else in any other quarter. Now, in 2021, interest rates were low. People were buying more apartments than ever before, and you can see in the graph that we have of apartment sales, there's a clear quarter. We have that highlighted in red. Far and away the leader of apartment sales. If you're talking about,
so it's this big red, period here. So this is Q4 of 2021. Yeah, that's a lot of deals.
Just for a little bit of numbers behind it, the 2021 number is approaching about 120 billion in apartment sales just in one quarter, and pre-pandemic, the peak quarter for 2019 was just a little over 40 billion. So 3 times more really than the pre-pandemic. Yeah. Anyways, the other thing worth noting here is the sales stagnation that we're having here, which is roughly about the same as like the darkest period of the pandemic. But
yeah.
I'll get to that in a second.
And so what else was going on during this period? So, I mean, performance was, well, I guess what was fueling?
Yeah.
So two factors fueling all these purchases.
You've got really low interest rates, really high rent growth.
Okay.
And, many of these buyers, many of the people that are making up the 120 some odd billion in that quarter, they used short-term bridge loans. Not all of them did, but it is a common strategy to use short-term bridge loan, and then you move on to a longer-term loan.
Or sell it.
Yeah, or you sell it. Yeah. But either way, 2 years of common, there is going to be a significant amount of people that have these 2-year loans. They started in 2021 when interest rates were really low, and maybe they assumed that interest rates would always be low.
Yeah, tell me, what was the thought process of these buyers? What were some of their assumptions? What did they think was going to happen and play out when they purchased these loans using bridge loans so I'm assuming low cap rates, so really high prices, there was high rent growth going on. What did they think was going to happen 2 years later?
Well, so, and I think this is all kind of speculating on what their mindset is.
Sure.
But if you get a bridge loan with a floating debt, then you're kind of banking on interest rates always staying low, because otherwise you wouldn't have that floating aspect to it. You just lock in somewhere. But so they assumed that interest rates would stay low. They also, a large portion of them assumed that rent growth would stay high.
Yeah.
And so
or if interest rates didn't stay low, like their worst case scenario was, well, if interest rates start increasing, we'll also see further rent growth as well. Yeah. That will all offset that.
Mm-hmm. That would make sense too. Like, oh man, both of those to go bad,
because it makes sense. But it's like, okay, typically if interest rates are high, that means inflation's high, and if inflation is high, that usually means that rent growth is high.
Yeah.
So I guess that tracks. It makes sense theoretically.
But this is, these are one of these long and lagging. What is it? Long and variable lags, and it just swung in a very unfortunate, way for people that. And I think a lot of people made these two really horribly aligning decisions when they were kind of planning out what their investment was.
Because there's already a lot of rent growth. Like when these purchases were being made,
correct?
Like there had already been, from a turnover rent growth, 20, 30, 40, 50% in many cases.
Do you remember? I remember talking about it in even like January of 2021, or maybe it was more like summer, but like almost like hyperventilating. Like it seemed like we all knew that it couldn't go forever.
No.
And I think that there were probably a large portion of investors that knew that as well, but
they're like, but we're getting it now. That there's a not only like a recency bias, but like an happening right now bias, bias of like, maybe not, but like, hey, we're getting it, and then the idea of like, well, we're going to keep renewing and we're going to keep moving these rents, and why not? But it was not uncommon to see buyers modeling, again, compounding any rent growth that would be going forward would be compounding after, again, this 40% rent growth.
Yeah.
So, and they're adding another 10%. And again, it's compounding. It's growth after growth. And additional 10% for 3 more years, they're talking about, more than 80% growth over a couple year period.
Yeah.
Whoever thought that, wages would be able to keep up with that?
Yeah. I'm getting the timing wrong. I remember talking to you about this. We were like,
oh yeah, we talked.
It's like times are so good. You have to have that feeling in the back of your head. But I do agree that if you could sum up it's almost like this recency bias that things are going to go as they've been going.
And I think we're dealing with the opposite problem right now.
Yeah,
just
totally
off topic, but also happening. But Matt, we talked about kind of the growth, the interest rate environment.
Yes.
The valuations they're buying these off of, cap rates.
Yeah.
Were they getting good, were they at least buying these at a good deal?
No, that's a good point. I didn't even put that one in my notes.
Solid deals?
there is that third factor is we were about near, maybe a little ways off, but almost peak valuations and, very, very
from a cap rate perspective, at least or really any way you want to measure it. Because I think that what the average cap rate in the nation was 4.5, but it was not uncommon to see deals being done in the Midwest, which you're typically seeing slightly higher cap rates, deals being done in the low 4% range, even sub 4%. I think we sold a property, Matt. I think for sub, I think it was like 3.25% cap rate, which is insane. Which basically means that you're paying up a massive multiple for future growth.
Yep.
That didn't.
I remember that.
Did not happen. Has not happened. could occur to some extent, but certainly, I guess, not in time for these borrowers.
Even when interest rates were like pretty good, pretty healthy compared to today, we were talking about things like negative leverage and or having the cap rate
just grow your way out of it. It's fine.
So
you create the positive leverage.
So and not only were we talking about it in a way like that would be scary for me. We were saying that, but then there were other people that were like that were wholeheartedly endorsing that position. Like, listen, this is what you got to do. Let's grow. And things. So that's kind of the cauldron.
So
there's a setup.
There's a saying, Matt, that says, "Don't fight the Fed."
Yeah. But here's the thing that they were.
Well, okay, so relate that to then and now.
Yeah. So I think that
the Fed, they were flowing with the Fed until the Fed pivoted.
Yeah. So
and changed their mind from easy free money to no longer free. But as the strategy from the buyers hasn't really changed. Everyone is saying, don't fight the Fed. If the rates are low, it's a good time to buy.
Yeah.
And technically, you could have been right if you did it in a way that could weather changes to that. That interest rate inflate that macro monetary policy regime. But when that completely flips on its head, you've made your bed.
Yeah.
But the Fed has changed.
You got
the direction
for 2 years. Yeah. And that's what I was going to say. Well, it's not necessarily fighting the Fed at the moment, but they have to. But I think that the key, if we're relating it to kind of to Fed decisions, when you're making that decision when it has low interest rates, you have to. Part of what's going around in your head has got to be there's some things you can't control, and you're not going to be able to control maybe if they decide to raise or lower it.
Yeah,
and I think that there was like. People were talking about like zero.
The idea, because so here's the thing though.
Yeah.
I mean, it's not, I've heard some people say like, well, no one could have known.
Mm-hmm.
No one could have known we had seen this much inflation. No one could have known we'd seen interest rates rise. That's just not true.
Yep.
I mean, there were certainly two different camps of, transient inflation is all going to come down. But I would think that at least, I'm generalizing, a lot of people out there also saw the amount of money printing that had gone on, the economy, being kind of kickstarted back, and a recipe for explosive inflation that could be very sticky, that could enter us into a little bit of a wage price spiral. And if that's the case, the Fed has no choice but to raise interest rates.
Yeah.
And so while it was not too hard to kind of see the next 2 or 3 moves that could happen in the economy.
Yeah. Even if you don't think that maybe it's 60% likely or 40% likely or whatever it is, prepare for that, because that, when you're talking about risk, whether it's risk that people are going to move in or risk that the interest rates are going to move away from you, you've got to be prepared for that, because that 10% vulnerability, that's what they're running into, is that 10% edge case where so many things are wrong.
And so putting all this together, and then I've got a couple other questions, Matt. So lower interest rates to higher interest rates, low cap rates to high cap rates. So the valuation has gone down, just based on if they were making the same amount of money, how you value a commercial property. Then also, rent growth and performance has been subdued. If you're getting you're not getting the 10%. You actually may have had to reduce your rents, but also expenses have gone up. Insurance, property taxes, payroll, all the raw materials. So that your expenses have gone up, your revenue, your income maybe has stayed the same or a decrease. So your net operating income, which is, your revenue stream that there's a multiple attached to on your cap rate, you're really dealing with much lower valuations. And then these loans coming due that were taken out at maybe 75% loan to value, 80% loan to value. And so now you can only get a loan at maybe 55 or 60% loan to value at a lower value and lower income and a higher interest rate.
The upshot to all of this, and we've talked about it here, and other people have talked about it, is this scenario where the owner has to come back to his investors and ask for more money.
So that was one of my next questions. So what do these borrowers do?
Yeah, that's their option. They either go back to their investors and ask for more money, or, dare I say it, maybe an owner in this situation would be willing to sell at a lower price, or a higher cap rate, or at a slight loss rather than a major loss. Now, I think human nature is going to avoid that loss, even the idea of it. And one of the things that I said that I didn't put in the report, more of a hot take than cold facts,
let's hot take. Let's
is that we have seen owners and lenders being super calm about this. They are not really actively confronting the idea that even if and they will, there's a lot of workouts, and banks are like, yeah, we'll give you, we'd rather have you pay the loan than, go bankrupt.
Yeah.
Even then, there is still going to be damage. There's still going to be a crisis that is going to be caused by, the simple fact that so many people were buying at so low rates, and now they're coming due, and the interest rates are higher. So you can't solve all of those problems. And I think that the upshot is going to be cap rates continue to expand. And kind of the hope is that it fosters more activity in the apartment sales market.
Just because things have to, not every deal will be able to be worked out, and there will be, not everyone will sell or decide to sell or need to sell, but more people will sell. And then, so you're saying that all these borrowers are going to be working with their lenders. And then on the last report, that's what we detailed, is one of the scenarios is that there's going to be a lot of, kind of extending and pretending, we're, we know your valuation is down 30%. We're going to kind of, I'm the bank, I'm going to ignore that. Like, I'm just, ignorance is bliss, and you're out of money. You can't pay your mortgage. I'm actually going to give you more money.
Yeah.
And to basically, I'm going to give you money so you can pay me my interest payments.
Yeah.
In the form of preferred equity. So they're taking an equity, this isn't always happening, but this is a that's in the
guidelines
case
that the Fed wrote, is like, the bigger the problem, the more help you're going to give them.
Exactly. So the more risk one's taken, the more help. So I don't know what the lesson there is, but it's not. I don't think it's a really a good one. So the big question that I have, and that everyone has, and I don't think that there's an answer, is it as easy as just all the lenders saying, we'll just work with everybody and extend? Can they? Can they just say, our whole book of loans, we'll all just, we'll extend everything, and we'll give you some more term, and we'll maybe modify your interest rate. We're going to loan you money to maybe do a buy down, or loan you money to cover, in the form of like a preferred equity.
Yeah.
Like, can they do that for everybody? And does everyone even want to do that? Because, if I'm at an owner, and that's the reality of a lot of these deals. It's like, okay, maybe they're not going to lose everything, but their returns are going to be so diluted now.
Yeah.
And they're going to be tied up for another year or two. I just can't imagine many investors are going to be too excited and too pleased. Yeah. And it's probably going to burn a lot of people from commercial real estate and multifamily.
Very good point. I wasn't really when I was thinking about people being tight-lipped, I was thinking of like the owner operators, like, we've got this ship's not sinking. We're turning it into a submarine or whatever, they're being very, very even keel about the whole thing. But, I bet that what could instantiate some real movement here is investors coming to that owner and being like, get me out of this. I want my money back.
And a lot of that'll be done privately. I haven't seen a whole lot, really publicly yet. But again, I'm just going to pull up the report just one more time.
Yeah.
We're seeing, we wouldn't expect, I'm going to go back to this chart, which I think is just, again, this is what, has been shared, across, the financial media. So this white bar right here, so this is September, right? This is where we are right now.
Yes, correct.
So there's really not a whole lot. We wouldn't be expecting to see the waves occur. So it's October. And this is when, decisions have to be made. This isn't things are on the market right now. This is like the meetings are happening. This is like, okay, guys, we're at the end of our rope. What's the plan here? We've got to make a decision. I'm sure some decisions have already been made, but then look at throughout, not just really 24, but really through 25.
Yeah.
It's a lot of loan maturities that are coming due.
Yeah.
That's a lot. It's $2 trillion essentially.
Yeah. And my question is, and I'm not sure what this due date is, is it do you go to jail if you don't pay it? Because I doubt that's the case. And I bet
give you more money.
Yeah. They just give you more money. Congratulations. I think that there is this wall of loan maturities that's approaching, in days. I bet that it gets kind of smoothed out over this long period through 2025, and that just creates this environment where maybe it becomes a lot more attractive to sell at a lower price than just to keep this kind of zombie deal going.
Well, some of those, and it depends on how many zombie deals, and that's a great way to, how many zombie deals are out there, because if there's all the deals turn into zombies, that also removes a lot of volume that can come to the market.
Yeah,
when we need that volume to come to the market for price discovery.
Yeah, I think that another thing that I was just thinking about is for banks, maybe they will give some extensions and accommodate not just the but not just the volume of multifamily loans that are coming due, but office loans, even industrial, the loans of all types.
But from what I've seen, multifamily and industrial have like the most coming due and the most kind of potential issues. And with multifamily, surprising a lot of people, just the amount of the volume of debt that's just not looking very attractive right now. Matt, so again, the report in June was awesome. It was covered across the internet. We keep getting people reaching out about it all the time. It was just really well done. This is an update. Well, I guess, what did you learn? What's new? What's different?
Yeah.
What did you find out? This graph was included in the first one. So like, or what, were you rehashing things here?
No, that's the only thing we kept, and we kind of added a little bit of context,
because this does visually really represent.
And that's true. And so like, yes, we kept that, but all all the other material and stuff was really new, and we really thought a lot about how we were going to distinguish this update from the previous report, and it is wholly an original report that's kind of focusing on different things about the loan maturities.
Yeah.
Specifically, one of the things is like, what has happened since June? Has anything happened? And I think one of the major things that happened, we covered the expenses and the rent growth and the low sales. Those are things that have happened and continue to happen since June. But one of the major things is that interest rate projections have gone from people thinking, oh, maybe we'll get out of this by 2024. And now it's almost certainly, interest rates will remain elevated. Higher for longer has dominated the conversation, and the calculation of these sellers that may have, maybe they'll hang on to this for a year. They can make their spreadsheets work. Well, if that's extended to 2, 3, 4, 5 years of a troublesome, debt situation, then that could induce them to sell at a little more than they are now, I think.
Yeah. So, similar to the last report, we kind of placed a couple different scenarios. I think we went a little bit more, kind of looked a little bit more forward into the future, interest rates in the economy, 2 scenarios. Because to your point, Matt, even when we did the last report, we were looking at, the 10-year treasury maybe ending the year at like, 3.75%. It's between there and like 4%. Certainly weren't thinking that it was going to be like 4.5%, 4.6%, where it is today. Go back a whole year ago, more than a year ago, people were saying at the end of 2022, maybe the Fed was going to, the Fed pivot thing, the rates were going to be lower. And then it was, well, maybe by the end of 2023, which obviously we're like approaching the end of 2023. And the can has been kicked down the road another year. Now it's end of 2024, perhaps. Yeah. And so the idea was, so many borrowers saying, we anticipate rates to be lower and we think it'll all work out. So all of these lenders, all these owners, borrowers, they've all been kind of hoping on a prayer that rates are going to be lower, and just still hoping for it. And I think that there's still the idea, and I believe that rates will probably moderate. Maybe at some point, but certainly to think that is wild. But they have not come down. Yeah. Yep. And they've actually gone up, and now we're looking at a 15-year high in the 10-year treasury. Yeah. So you can't get on any permanent debt at a decent rate. Yeah. And the floating rates, it's so Fed funds and SOFR has been stuck at 5.25 to 5.5, and there's talk of another most likely ornamental, but an additional maybe 25 basis points before the end of the year, which again I don't think is really necessary. But again, it's the Fed wanting to display their confidence and like they are. And don't think about, turning up this economy, investors, because cost of capital is going to remain high. No. Until the federal government, they need to get it down those, because the federal government we're spending way too much money that we don't have.
That's a good point.
And all of these treasuries are going to be, coming due, and instead of paying 2%, now they're going to be paying 4.5%, 6%. We're basically doubling the cost, for the government to borrow. And
Yeah,
we've spent we've spent a lot of money that we don't have.
Yeah, and we've said this before. Even if it doesn't move, if it stays high, that's still painful for a lot of people.
Yeah,
and I think that it, just thinking back at the beginning of the year, even in June, there was such confidence that there would be a recession, and that was our. So we had the two scenarios up there from the report.
Yeah, recession and rates lower by.
Yeah. So a recession that really just kind of cleans up things, that like brings values down to the CRE market. Everyone gets a present under their pillow at night. Interest rates are down and all the problems are solved. But
do you think this is all a potential catalyst for a recession, man?
I think it could be.
Yeah.
That's one of the things that I was noting here. Everyone seems so calm. There is attention that's paid a little bit on these loan maturities. I think that the majority of the attention does seem, at least for the multifamily, I could be biased, but like they frame it like, oh, this is going to be an opportunity to buy.
Yeah.
And I just don't see people talking about like the crisis of it. They do talk about it, but I don't think they're talking about it as much as they should, given that there's all these patterns that we've been following. When interest rates go up, economy goes down. Interest rates have gone up for so long, economy hasn't gone down. And I think that one of the things that interest rates do to damage the economy in this way is to bring valuations of assets down.
Yeah.
And so
that's the one thing that I feel like we're slowly starting to relearn, is that like some of these, laws or principles of economics that like were kind of pushed to the side over the last cycle because, we never saw an inflation pick up.
Yeah.
We're still spending a lot of money. And there's a lot of like, there's decent reasons for that.
Mm-hmm.
It's taken us a while to be like, oh, a lot of those principles actually, do come true. But COVID was so impactful in how it, threw off all of our, kind of bases for everything.
Yeah.
But that doesn't mean, so it's like our timing is messed up, but to believe that, we're going to go through some period, completely unscathed.
Yeah.
I'm an optimist, but it doesn't seem like we can defy gravity for that long.
Yeah.
And what comes up must come down. And there needs, in the Fed, every time the Fed has had rates so low, it's class, especially, look at, Austrian economics, or just, listen to Milton Friedman. I mean, it's classic. The Federal Reserve has created an asset bubble with, incredibly low interest rates, and then they rush in and then they create a recession to deflate the bubble. And I wanted to bring like I wanted to blow up a balloon, and it's not popping, but it's like when you stretch like the opening on it, and it's kind of like
no,
that's what it feels like.
Yeah.
It's just kind of sputtering and kind of we're sort of deflating right now, but then but then energy comes in, oil prices are up, and it kind of fills the balloon back up a little bit more.
What's super interesting is you were talking about this in mentioning expenses is COVID has changed some things, and with the Federal Reserve and with interest rates, they swinging back and forth, and we're seeing, apartment operators have seen increased expenses much later than the average consumer, just because of the way that contracts work. They're just getting this double whammy of higher expenses, lower rents, loans coming due, and it's all because it's like this mirror version of everything was going great in 2021.
Yeah.
And all of these things are now they're swinging away, and they're aligning in a way that is, you could see it as like the natural progress of events, but there's so many complicated rhythms to this that it feels unfortunate, and it would feel certainly unfortunate and almost unforeseen if you were on the bad end of it.
Yeah. Okay, so Matt, for multifamily investors, what does this mean? And I ask that because it's a confusing time. So we got cap rates are higher.
Mm-hmm.
They're like 5.5, 6.5 ish, plus or minus, which is better than 4.5. All right, so some prices have come down. They look a little more attractive. Interest rates are up though, so that makes it challenging.
Mm-hmm.
Rent growth is pretty subdued. It's growing marginally in some places, negative in others. We'll see if that turns around. Seasonally, probably not going anywhere. But because of, NOI and value and, revenues kind of being flat and cap rates going up, the price to purchase, like your kind of price per pound, price per unit, when you always look at it relative to replacement costs and what it would cost to build the things.
Yeah.
some of those prices are becoming more and more attractive. At least, when we look at dozens of deals every week or so. And so the prices, on a price per unit basis are starting to look attractive. The cap rates, the headline cap rates are starting to look attractive. But again, because of interest rates, because of growth prospects, the returns don't look good.
Yeah.
Do you look at the math?
Yeah.
How important is the math? Seems pretty important. I mean, that the math doesn't seem to be working right now.
It does. I think that's the key thing is like keep paying attention to the spreadsheet. And even I think that there may be temptation, for some operators and companies, a downright need to just buy it. If you're one of those companies, and that's kind of your business plan to keep this deal flow going, then, maybe you can swallow a little bit of a loss. But all things considered, I think that there is room for the market to go, for cap rates to go up even further, for valuations to go down even further, just because we haven't seen the big dramatic moment, which is just around the corner.
Yeah. Will we get that moment though? That's
so,
what we're waiting for the moment. You and I are waiting for the moment. Everyone's like waiting for the moment.
The realist in me says that we'll never, we won't see it until it's over. That's the realist. But my hope is that we're calling it a wall, a wave, whatever it is.
Hydrogen bomb.
Yeah, hydrogen bomb. What we said in a video, that light at the end of the tunnel is actually
it's a bright blue light.
But hopefully the difference between the stark difference will result in some things that, oh man, it is noticeably different. Yeah. And there, it's not like there's a million markets that go on, or a million buildings that go on sale every year. There could be, a relative handful of apartment deals that kind of make the market, especially considering that there's low sales volumes now. So I would be I'm going to be really interested to see how things pan out in October, November, and December of this year, just to see where they're at, and to see, what kind of decisions are being made. And especially, I wonder, in January, start of the new year, all right, let's face facts. So that's what I would say is, I haven't seen, to my great disappointment, I haven't seen any intelligent owners, who are like, I see the loans and maturity, I'm getting ahead of this while I have a good value. For the most part, it seems like they're holding on for a miracle. And
there is. So, I mean, we've got some reports of some deals, that are, more deals are being listed. I believe, Fitch had a report that, they're projecting distress to go up by, like 500-700%, but that's because like distress moving from like 0.3% to like 4%. So it's like not, but a lot more distress. It's certainly over a couple percentage points potentially. We're also hearing some story, some articles with there's been a handful of sponsors been in the news repeatedly,
big.
And we haven't really wanted to talk specifically on those, but big story of Tides Equities piece. Their lender, I think Arbor Realty Trust, doing a big modification with them to provide that preferred equity so they can carry their debt service. And so like there are things being worked out, but then again, like we said, is it kicking the can down the road because these deals, they're zombie deals. So what happens to them at the end of this extension? It gives them more time maybe are they just thinking rates will come down by then? Hopefully.
A part of me, thinks like the same wishful thinking that they had in 2021, like these good times are going to keep rolling. Yeah. It's also kind of involved in like on the bad times. Also, the bad times are never going to come too.
Yeah. What does all this mean for it? Like, if I'm an investor, what do I do right now?
You know what? I think that keep your eyes open. Yeah. Because and get ready. Watch for kind of major movements through this quarter, and I think be prepared to capitalize it in January. Yeah. This is just talking to Jay. Jay made a very good practical point. Like, we may not see a whole lot of deals come up just because of the way that how long it takes to execute all the different nuts and bolts of the deal and due diligence and whatever. People may hold off during the last quarter.
We were talking about this yesterday, and that's what I'm really interested in is what all comes to market over the next couple of months, because typically It's a slower season in terms of new deals coming to the market. There's a couple of things, factors. One, have the holiday season, end of the year. So, one, it's hard to get people to work. Thanksgiving through Christmas. I mean, it happens. We've done it many times, but it's not always the best time. Certainly doable. But it's who wants to be doing on tours and, mid-December and stuff like that. Also, people want to close before the end of the year. But this year may be different because the volumes have been so low. And if all of a sudden October now is a time where these discussions have to be taking place, I can see that since relative to volumes, the volume in Q4 of this year relative to previous fourth quarters will still seem low, but relative to this whole other year actually may be elevated.
Yeah, that's a good point.
Just because some people are going to have to make something happen, and it may not be for deals to close before the end of this year, but they're going to be brought out and floated and discussed to close in January and February. So I think Q1 of 24 might be a big quarter.
I mean,
might.
What another motivation? What about, brokers? Their backs against the wall after 3 quarters of low sales. And I've seen some brokers that could sell snow to an Eskimo. Maybe they are they work their magic and really as a force.
No, so there's some great brokers out there. And the one thing though is, and they know this, you never want to really trust a broker's pro forma, which is the broker basically says this is kind of our underwriting of what you can use. And
it's always says it's way profitable.
Yeah. It's always you're able to get more rent and more other income, and there's not going to be any vacancy.
Here's from the perspective of the seller, basically.
Yeah. Ideal, best, if everything happens perfectly.
Yeah.
But there were some that, it wasn't too ridiculous. It wasn't too far off. It was kind of reasonable.
Yeah.
And it's a big mistake. It's a big mistake though to just take those numbers. But man, as deals have gotten skinnier, and they have told a seller that they were going to get $50 million 6 months ago, and that seller 3 months later is all right, let's go, and then all of a sudden I'm not going to be able to sell for any more than $35 million.
Yeah.
They're we can still, or 40, and they're
50, well, right?
They're we can get it for 50. I have 50 in my mind.
Yeah,
and they're well, yeah, we can try. And so there's a lot of anchoring issues.
Yeah.
But so to get to that 50, the assumptions that brokers are using in their pro formas are so rosy, and they're basically taking last year's expenses, even though they know property taxes have been increased. They know insurance has gone up. They know all the expenses have gone up.
Yeah.
But then they're using whatever the highest income month is, and then they're basing their cap rate on that to be oh, it's actually a 6 cap. Well, no, if you actually look at it, it's it's still a 5.
That's what it seemed like. It seemed like the conversations shifted from telling the buyer hey, look at how great this is. Really, 50 is great. And now they have to go to the seller and be listen, actually 35. The conversation is now not convincing the buyer that the high value is good. It's convincing the seller that maybe a low value is good if you actually want to get this sold.
In 2021, all they had to do is they took the meat of a property and they just threw it out the street, and they all the dogs back just come in and rip it apart for $10 million over asking or whatever. They didn't have to do anything. The brokers were saying this property max is worth 55, and some become 60.
Yeah.
Take it for 60. I'll buy it. And then again, it's people were paying ridiculous prices.
Yeah,
and they didn't make sense. And those loans are coming due, and the valuations are completely changed. So, Matt, where can we go to find this report?
graycapitalllc.com/report. You'll just fill out a short form. We'll have that emailed to you immediately. I tested it this morning. It works.
That's good.
We got a press release coming out, so watch for that. We're really excited about that. And we got a webinar. Yeah, October 12th.
Yep, October 12th. If you're watching this video, I guess after October 12th, it'll be on our YouTube.
Yeah, we'll have a link in the comments
with the replay. But if you're watching early October, put it on your calendar. You can go over to graycapitalllc.com/report. You download the report that'll allow you to sign up for the webinar.
Yeah. So I'll set that link up too.
YouTube Live, awesome. Really cool, Matt. Great job on the report. Again, it's just we didn't want to make it in the webinar. We go into a lot more detail. We go really into the weeds. We find this kind of 2-page research brief a really good format that can be consumable, gets you the data, gets you the facts, gives you some analysis. You can, move on.
It's small text. This is not like you don't get 3 numbers here. There was a lengthy period of me taking stuff out of here, and so really trying to boil down to the most important things about this issue. And I think that we focus on some really valuable stuff that will give you a clear-eyed look at what to expect.
Absolutely. So, all right, Matt, let's move on. Let's talk about this piece from CBRE.
For sure.
Older versus newer. Okay, so older multifamily properties achieve above average rent growth. Okay.
Yeah.
Interesting.
I know. I was like a little bit confused, and I'll be honest. It was like a little bit surprising that CBRE has measured this fairly protracted period of reduced rent growth, which lasts for the first 10 or so years of a building's life relative to the following decades. I know that when an apartment, now this is my kind of conception, is, when an apartment's newly built, the developer or owner tends to offer some attractive concessions and rent discounts, maybe even just lower rent to make sure that the new empty apartment's filled up with renters as quickly as possible. So maybe like the first 3 years or so, the owner's slowly phasing out those concessions and discounts, raising rents to market level, things normalize. I could see lower rent growth in the first 3 to 5 years, but 10 whole years of lower than normal rent growth just doesn't seem like, I can't wrap my head around it.
Yeah.
And so I have a theory. So CBRE explains, they said this trend is largely attributable to pre-2010 properties having lower average rents and therefore more room for growth in a continued high-demand housing market. In addition, older properties' rent growth has been less volatile, meaning they have been less affected by external shocks like recession. I'm a little bit at a loss. On one hand, the report concludes with a message of like older buildings in general have higher rent growth, and that kind of broadens or generalizes that point. I think that perhaps maybe instead of the blanket idea about all older properties all the time, there's like a historic factor that like the properties that are older now have not been buffeted by this 1-2 punch of the Great Recession and the pandemic, or are they falling on, are those recessions affecting at any, their sample size? And then Griffin kind of set me straight as maybe this is the third option, is probably more, and it's something maybe you alluded to when I talked about this yesterday, is maybe around year 10, you get someone that's their interest is in rents and really the cash flow of the building, not necessarily like how much money you make selling it. And because of that, like the operating and the income that you're getting regularly is more of a focus for people that are owning more older buildings, then that will drive rents up.
So let me ask you a question.
Yeah.
I think this might get us where we're going.
Okay.
If an older property had a lower return than a brand new property, why would you?
Yeah, good point. Yeah. That's flat out. The thing that,
and we're not talking really about returns. We're talking about rent growth.
Yeah,
and there's a reason for that. But just inherently, this isn't surprising.
Yeah.
It's surprising because people say, it's like, no, it's good, but it's not surprising when you think of, risk in return and risk equaling return.
Yeah.
And CBR mentioned it's like the older properties. It's not. Rent growth is one component.
You got more expenses.
Now, it does say that there's less growth volatility, but again, we're only looking at one metric here, and that is rent growth, which is definitely a big component, but it's not the only component.
Yeah.
So, I mean, again, they show volatility on the, and that's those like little like lines. I mean, just being, slightly less, the older, just the less volatile they are. But I mean, and I hate to just use like a bucket of anecdotes when like talking about all this, but like it's the best tool, I guess.
I can't understand it other ways. It's just an example.
So it's the mom and pop owner is the best example in case. So they own this property.
Griffin had one. I'll have to tell you.
Okay, good. Okay, so it's like, I'm a mom and pop, literal like husband and wife. They've owned the whatever unit property, 12 unit, 50 unit, doesn't matter, since the 70s.
Yeah.
They haven't really raised rents on their tenants. They don't usually. Every once in a while, it's just like a nominal little bump up. So it would make sense that if a new owner came in, the delta between market rents and their in-place rents are the largest versus a brand new property that's brought to line that's hoping to achieve the highest rents in the market or close to it, assuming that you are at or near the ceiling, there's only so much room that you can grow. So there's not a lot of, headroom. Or again, it's hard to execute a value add business plan on a brand new property, a newer property. There's just not as much value to add. It's already brand new. What do you do? It's already got, LVP flooring. What do you do? The new LVP flooring in, it's a little bit of a different color. How much rent growth are you going to get that versus an older property where I can go in and put in some new flooring, maybe some new appliances and get $200.
And that's what their graph does include renovations too. So, I think they would probably have to include it, because what buildings wouldn't be renovated?
So I guess it's I think the headline's like, really? But I think it makes it a lot of sense.
You're right.
If you start.
Yeah. And I wasn't disagree. What was dissatisfying to me reading it, what left me kind of puzzled was they didn't dig in too much into like why this would be the case.
Well, they needed us to talk about it.
That's right. I'm glad we're here.
Well, it's also, I think also why maybe there's a little bit like, is because we have some recency bias of seeing brand new properties being delivered and getting really strong rent growth.
Yeah.
I mean, we've bought a handful of newer properties that like we didn't model much rent growth, and then we got a ton of rent growth.
Yeah.
And so like in our recent history, personally, has been we get some good rent growth on some of the older properties, and we get some good rent growth on the newer properties. And so in some cases, I mean, it's what we started seeing really a couple of years ago, is that there was so much demand for value add deals.
Oh, for sure.
And so all the value add deals are being priced up. So like you're paying a 4 cap, and this was like before, COVID. You're paying, 4 caps for value add deals because the potential to move rents, that potential for rent growth, saying like, you're buying at a low cap rate, forget the cap rate though, because, you're going to be able to come in here and raise rents $300 just by not doing anything, or you can, throw in $10,000 a unit and you can raise rents $300 whatever dollars. Yeah. And so you can force that appreciation that much quicker, where you just don't have an option on the, Class A new stuff. Yeah. And so, but it gets to a point, and we started seeing this in our strategy shifted, where we were really only doing value add deals. But then once we started seeing, we started, underwriting value add deals and underwriting slightly newer, not brand new, but, call it, like a deal that was built in mid 2000s or 2010 or so, versus a deal that was built in the 70s or 80s. The 70s and 80s deal, you have to go in, you have to spend a lot of time, money, resources, it's a lot of work. And the end result, if everything worked out, was like the same returns as if we bought something and just like kind of tweaked it a little bit. Yeah. And I'm like, okay, like complexity versus like complexity. Something that was built in the 2000s versus was something in the 70s, it's going to all fall apart. And then I'm like, okay, well, but if the 70s deal is like giving me a really big return, like that would be the reason to do it. Like we talked about. Yeah. Like why would I go through the headache of, dealing with just a more complex business plan? Yeah. That we can do it, but it just takes up more bandwidth.
And if the cost of the renovation is, is as much as you'll be making from the rent growth, then that's, part of the calculation too. That's
So it's, trying to work a little bit smarter rather than harder. And so we shifted for like, let's buy a little bit newer properties. We're getting the same return for less work.
Okay. That is really interesting. And
so it shifts around and,
and you can see that in this chart too. I mean, the 60s, then buildings built in the 60s have slightly less rate growth, and then it kind of peaks in the 70s and goes off.
Exactly. So it's like, why would I? Okay, so it's like, okay, I get it. If this is the case, the 2010s and newer, you're not going to get the rent growth. But if you're telling me, Matt, that I'm going to get the same amount of rent growth on my 90s built stuff than my 60s built stuff, I'll take some of those built in 1998 all day long versus 1968. Are you kidding me?
Yeah, that's a really good point that puts it perfectly. What you said is like, all things considered, people are going to, and there's physical reasons and emotional reasons, they're going to pick the newer thing. And that's going to maybe put a little bit more of a premium on that.
And it typically does. Yeah. It typically does. But then again, we just started seeing value add, which again, always looking to create value in some way. but it was the business plan because it's even though it's, I would say, more difficult from a moving pieces standpoint, it's the lowest barrier of entry because it's like you go in and you buy something cheap and you fix it up.
Yeah, it makes sense.
Improve it.
You can tell the story to investors.
Exactly. Yeah. And you have the highest opportunity theoretically to force appreciation because you have a very just, we're going to go in.
So control.
Fix the, improve the, we're gonna spend $10,000 to fix the interiors. We're gonna be able to charge $300 more, per month in that unit.
It's a little harder.
Straightforward.
It's a little harder to imagine. Oh no, the demographics of the city are changing, and the economics. We're going to get this organic rent growth.
Exactly, which some of those you can actually do. You're speculating,
and we experienced that. And so
there's definitely momentum plays where it's like you're buying it stabilized and you're taking advantage of the market momentum. You're speculating a little bit on again that area and the market and the economy, but if you have a good grasp on the market and generally kind of where the economy is, you set it up so it kind of doesn't matter. You can kind of wade through some rough weather versus the value add where you can force that appreciation, move the rents, get a higher value. Yeah. But it's easier said than done to get from point A to point B. Yeah. It's not like you turn a key and then all the units are renovated and the rents go up.
Yeah.
You got to physically rent it. You have to create the vacancy. You have to physically fix the units.
Yeah.
And then you have to sell the market on the new rent growth without causing delinquency and disrupt the whole property. All easier said than done. But it's an interesting report. It's a good topic. It's worth always re-examining. Okay, what we're doing in our strategy and looking at the vintage of like, is this kind of the right like vintage like swath right now that we want to be going after?
Yeah.
Like is the early 2000s a sweet spot? Is it the 2010s? Is it 2015? Is it mid 90s?
I thought that was one of the interesting things is looking at there are specific characteristics. They were born, these buildings born in a different environment.
Yeah.
The style of the building is different. But
that's a big thing too. The physical obsolescence of like, what do you think about the ceiling heights are going to be in the 60s versus like the 2000s?
Yeah.
Like short, we've changed the way when we're designing things, the way we use and.
Yeah. I remember a couple years ago, I wanted you to look at it. Maybe you didn't.
What?
The historical building and you were like, but the room sizes are from the 20s. It's like we're living a different life than we were when these buildings were.
There's like a little closet here and it's like it's cool and some people find that really interesting and there's a niche for that, but it's like your average person like it's not really what they're going for. New, big, clean. I don't know, something
super interesting,
a little new. Okay, Matt, we got a piece. We're talking about Florida. We're talking about Minnesota. We're talking about different markets. Man, we're talking about a hot market and a cold market. Okay, Matt, cut the BS though. Florida's nice. Minnesota. Florida has oceans and beaches, Disneyland, dolphins, fishing. Miami. Minnesota has fishing and lakes and a lot of snow and snowmobiles in Canada.
They got seasons.
They've got seasons.
They say season. Now, I think a lot of people don't care about seasons.
A lot of people in the South, like they'll say, like, I just miss the seasons, and I get that. But it's like they're not all that are cracked. It's not all cracked up to be. So you can just like drive 12 hours north and just turn up your AC. So there's a couple pieces. Talking about Florida and Minnesota. First, we're talking about Florida, right?
Just a little. To whet your appetite, a little local focus.
Moose boosh.
Yeah, a little moose boosh. Small bites. If we're going to put a local spotlight on Minneapolis, we want to talk about Florida as a little bit of a mirror image in that, we don't need to explain how much Sunbelt cities have grown over the past 3 years or really even longer, but there's been Greg Willett at Institutional Property Advisors really gives us the numbers on how much migration there has been and how much job growth there's been in Florida and how many higher paying jobs there are. Just this burgeoning economy throughout the state. I think it's exemplified by Miami. That's going to be my exemplar for this apartment market that we have seen consistent rent growth throughout the pandemic. When things were surging, Miami had great rent growth. When things were starting to kind of snap back, Miami was still going strong. And I'll just only mention this. Minneapolis was really the opposite. Whether it was good times or bad times, Minneapolis was underperforming. Now, I think that the story of Florida, which is a little unlike Minneapolis, which I'll get to in a second, the story of Florida really is like how much population growth, how much the amount of renter households has grown in the past 3 years. They say for certain markets like Jacksonville and Orlando, renter households are up 10% or more. And for the state as a whole, it's renter households are up 6% or more. And, we're talking an environment where, typically you're not building that many more apartments. You're not building 6% in 3 years. Sometimes they are.
I was going to say they have been.
Yeah. But at the very least, they're definitely supporting it by they have the demand that can absorb some of this construction a lot more than other people. Really, these favorable migration patterns. They have a map up there in this report where it shows how it's really like Florida, Texas, South Carolina. These are the places where people are moving. And jobs are kind of following too, and they highlighted in the report the super high these kind of luxury properties are getting more they're getting more in demand, and they're kind of speculating that that's going to be a larger group of renters in places like Jacksonville or Miami or Fort Lauderdale. That's great for Florida. That is the summary. Now, I think that if we turn to Minneapolis, the story is much less sunny, but not. I don't think it's as dismal as one might assume. I think that Minneapolis is it is a stronger market. I also think than some other people might assume, and it has really been it's such an outlier for all these Midwestern markets. We have tracked it for 3 years. For all 3 years, we've been looking at places like, even Chicago had a little rent bump that Minneapolis didn't. But, places like Kansas City, Indianapolis, Columbus.
Man, we've been ripping on Minneapolis for
I know,
and
it feels
years.
bad. And
I like Minneapolis.
Yeah. Steadier there. I like that band. They've got exactly. 1,000 lakes. They've got you look at the picture.
I like Minnesota.
Yeah, I think that they're to
visit.
Yeah,
maybe I don't. No. It could be great.
Yeah,
I'm just
okay, but that's a good question. There has been a lot of questions on why rent growth has been so poor. Why, if you were an investor in a multifamily property in Minneapolis, you wouldn't be seeing all the great things that maybe someone in Kansas City would have seen. And I think that I'd like to think that was not a reaction to like specific events and more of like a larger trend. And one of these things, so you even mentioned this Bloomberg article that talked about Minneapolis, and I found it last night. It said, first American city to tame inflation owes success to affordable housing. Now this is like via the Seattle Times, but again, a bold headline.
Hold on, okay. So it's the Seattle Times writing.
Yeah. I have that in the tab there, but it's it says it tames inflation and it owes success to affordable housing. My intuition is that some people might interpret taming inflation with just like because people were leaving and they're not spending money. And they might say, again, this is just a speculation. They might say, the cost of living went down because all the people and the businesses left after the George Floyd protests. That's the number one thing I was really curious about. I looked up, I couldn't find a whole lot of things that were specifically saying that like people are fleeing the city. There is of course stuff about like police reforms in the area.
I think that was just overblown.
It may have been. At least it's not as big of a factor as some people think. I think for certain neighborhoods, certainly for certain people, certain businesses.
It wasn't a positive thing for the city.
Yeah, and it definitely wasn't a positive at all. And I've got a couple of graphs that I looked at. I looked at GDP and population growth. Now it's very broad. This is a bird's eye view of things. I'm sorry, I have it on the Google Docs here. But if you look at the trend lines for Minneapolis and compare them with a bunch of other Midwestern cities like Chicago, Columbus, what do I have here? Detroit, Madison, Kansas City, Columbus, Minneapolis. And basically Minneapolis is like middle of the road for population growth, maybe on the lower end. And there's an argument. You could say that there's a correlation between population size and population growth, in that Chicago had low population growth. Detroit, which was number 2 size in the Midwest, had low population growth, and then the number 3 was Minneapolis. It's hard to see in seeing it ranked kind of in the middle of all of these. It doesn't look like everyone was fleeing Minneapolis. It's following very similar trends to other ones. And this kind of the same case is for the GDP. Minneapolis, very much middle of the road. Now I'm not talking about raw GDP or raw population numbers. These graphs are just how much things increased year over year. And the proportional year over year increase, they're all tightly grouped together and following the same trajectories. So again,
so their economy didn't
really plummet. Their population is more aligned with the lagging of like a Chicago.
Yeah.
But definitely not like a dramatic thing you can point to as like.
So it's kind of got like slow growth, like a bit you would see in a big city. But Minneapolis isn't a small city, but it's more akin to I think it's larger than Indianapolis, but I mean, it's more like an Indianapolis than a Chicago.
Totally. And again, there could be, like I said, like markets, submarkets, population groups that really had a hard time in the wake of, either protests or the pandemic or whatever. But I think that if you look at it, if you flatten it out just to the total population growth and GDP, that's the story. Now, I think, in fact, CoStar really lit me onto this. It's like, what's the apartment supply story? And CoStar's summary of the market, it's like, that's the answer right there. They said
weak growth, and they just built a lot of apartments.
Built a whole lot of apartments, totally. So it said, CoStar says Minneapolis's multifamily market has posted 5 consecutive record-setting years of net deliveries. 5. That's going back before the pandemic. So it includes the 8 highest. Blah 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 blah. I want to say, the largest increase in 3-year supply growth relative to pre-pandemic levels among all major U.S. markets. So this was even in the early days of the pandemic. Minneapolis was building more than it was building in like 2019, 2018, et cetera. So they were building throughout.
Why do you think, what was the kind of the thesis, to build a lot in Minneapolis?
So that's what the Bloomberg article kind of describes. Now, I don't know how much of a heavy hand the mayor had or the city council or whatever. I did look into rent
because you can't like twist developers' arm. I mean, they can use a lot of care. They can sweeten things up.
What they did, which and I was going to mention rent control, but actually rent control is not necessarily even a factor for this too. There is a 2022 rent control ordinance that was passed in St. Paul, but there's ways for developers for landlords to kind of get out of it. But there's no rent. There was rent control discussed in Minneapolis, but not. So rent control, no.
Well, then why would you need rent control if you're building so many apartments and the rent growth is low?
Yeah. Well, and there's an argument to be made
if rent growth happened, they probably wouldn't have built apartments.
And if rent control was in, exactly. If rent control was in place, rents may have been higher for uncontrolled ones. Yeah. But what they did was better. It was a carrot approach. There was like 320 in subsidies, but I think the more
320 million.
Yeah. 320 million subsidies, but also they deregulated a lot. They classified places that were single family into multifamily. There's a couple great quotes. What is that the mayor said?
So the only people who should be pushing back against kind of deregulation of zoning and these incentives are apartment developers who want their prices to stay up and rents to grow.
Yeah.
Those should be the only people who like push back because they're, they want to be protectionist, for their own assets and I guess property owners, relative to, some land values, but there's not a whole lot of good evidence to show that, apartments, kill land values.
Yeah. It is interesting too, because there is a quote in that, that talked about how it was the mayor saying like, they were concerned about gentrification. And he's like, well, no, the only thing that really happened was rents went down.
We talk about Jay Parsons, I feel like all the time. Jay Parsons had some really good takes on LinkedIn on gentrification, really just taking an axe to the argument of really highlighting the positive benefit, and people will roll their eyes at this, but the positive benefits of gentrification.
Yeah.
I mean, gentrification usually, leads to more diversification, of a neighborhood.
I sympathize with the people that, my taxes just went up and I didn't even do anything. I get that argument, and we've talked about this before. There have been plans. I think it was like a right-wing think tank that talked about how you want to build these buildings. Well, maybe the multifamily property or whatever kind of absorbs some of the greater, whatever the tax burden of the people that, they're not the ones that are changing the neighborhood. I kind of sympathize with that, but I also think, what?
Your tax is going up because your value's gone up.
Yeah, exactly. Well, and ultimately, and they kind of say this in the article, this NIMBYism, you're never going to build. You're never going to build an apartment anywhere if you have to ask all the neighbors. Eventually, you're going to have to make people unhappy, so that you can have to make a small group of people unhappy to make a bigger group of people happy. And I don't want to say suck it up and get used to it, but from my perspective, I've thought about this a lot, and I was even with my parents. They have a yard and they're thinking, oh, maybe, is the neighbor going to put another house there or something? I'm like, you know what? They can. I'm not saying, I don't know what the regulations or anything.
Obviously it's always a balance, living in society, obviously, there has to be some communities should have some general rules of what you can sort of can't build. But if, from a standpoint of property rights and it's your property, should be able to kind of do. I certainly lean on it's your property, should be able to do what you want. Unless you're really really infringing on someone else's property rights.
Maybe if you're if I can't grow my tomatoes or something because the big tower's in the place, but that's not what people are talking about. A lot of the density, and this is going off of this is not necessarily like the multifamily that we invested. A lot of the density that's needed in many of these communities are 2 to 9 units, or it's like a quadplex. You could drive right by, you wouldn't even know that it's a quadplex. But because of these, there's this abstract. I think that the housing crisis will only be solved by a greater regional power exerting itself over local power, and that's antithetical to a lot of people's conception of kind of democracy. Yes, you rule your own. You rule your own
or small
area.
Government, and it's the some of the small government, conservatives will go then at the state government to tell the local municipalities that you can't make rules. But
then they're all like,
but they're rules to protect the individuals from municipalities, and so there's a lot of irony in it.
Exactly. They'll like the individual, right? It's not clean anymore. If it was, it's not perfect individual rights and we should have control over what's happening in our neighborhood.
Do what they want and doesn't hurt anybody.
But then what if those same people are like, hey, actually, I want to build this store on this. And you're telling me that because the facade's wrong now, who put you in charge? Oh, the local government. The same local government that may be protecting you.
Yeah, well, and that's the criticism that you hear from the builders all the time is, a lot of these, building commissions or zoning boards, that are supposed to be dealing with, their purview is a strip club can't go, shouldn't go here. It should be apartments, or you have to have offsets from the road. These are the rules. But it's devolved to what was your what type of bricks are you using? This is the aesthetic that we like, that we're going for because it matches this one other house down the street that we think is really cool. And can you make it look like this? And you can change some of these architecture. It's like what gives you the right? Because often these aren't even elected people. Sometimes they are, sometimes they aren't.
And oftentimes, and this is only just through some conversations with some of the legal people that we work with. Oftentimes they're not the ones that are saying yes or no on it. They're a recommending body, and they go up to the people that make the rules and say, this is our recommendation for this development. And so if you are powerful enough, and so if you're powerful enough, have the relationships with the high ups, then you can bypass the local government. But what that ultimately means is that the little guy, it doesn't get any power in this situation.
Not at all. And heaven forbid you're dealing with a historic preservation commission. I mean, talk about tyrants. And I'm sorry if any of them are listening, but they just don't have a whole lot of respect.
I do.
I kind of respect the idea, because I got back into real estate investing because, I saw neighborhoods in Indianapolis that had been run down, being turned around. And these were, not, we weren't buying houses from renters and turning them, taking abandoned empty houses and fixing them up, turning them into, creating nice communities. And these communities are flourishing today. But the one group that was standing in the middle of, if it was up to them, they would have just let these buildings just rot and fall to the ground. It's Historic Preservation Commission. If you want to talk about like nitpicking on things that don't matter, that shouldn't matter, I mean, go down along.
I liked your door story. That's a good example.
I can I'll briefly tell the door story. So we bought this house. It's flipping. It's before I got into multifamily in Indianapolis. And the previous owner, someone attempted the past owner kind of tried to do some work. They didn't get that far. And so we fixed some of their work. But one of the things they did is there was a steel security entry door on the back. Kind of a cheap door or whatever, but like that's what was there and had a big dent in it. And we're like, the door is fine for the neighborhood. That's what that's what most of the houses had. Like this exact same type of door. But it had this dent in it, and I was like, well, let's get a door that doesn't have a big dent in it. And so we bought the same type of door, the same door that was there. And the Historic Preservation Commission had already been out to the house, many times. They come back out again to do like an inspection, and they look at the door, and they're like, is that a new door?
Oh, they were mad?
They were mad. And I said...
So it wasn't like, oh, is that a new door?
They were like, see, we have a new door here. And I'm like, well, yes. The door was dented.
Yeah.
And because the rules are you can replace it if you're replacing with the same like materials and the same thing.
Mm-hmm.
So I read, and that's what like the rule is.
Yeah.
I'm like, well, it's the same thing. We just replace what was existing. But in their mind... They're like, oh, no, when I say the same thing, I mean what was installed when the home was built in 1870. I'm like, well, I don't know what type of door. I mean, probably wood. I guess that's what you're getting at. But you just... And so, instead of, the $500 security door, they wanted us to buy the $5,000 wood door. But like, what are you talking? You're just both making it up?
Yeah.
And I'm like, well, let me get this. But I'm like, but if we hadn't done anything, if we hadn't put the new door in, the dented door would have been okay. And they said yes. You can either put the dented door back in, or put in the $5,000 door. Yeah. And I was like, oh well, I'm going to put the dented door back in. But well, actually, what we did is we told them that we put the dented door back in, and we got the dent out.
Yeah. Well, I know.
And we're like this.
You won. You did it. We put the yeah.
And then it's like we did all the there's all this other stuff that we had to do, and we did it, and they still like were attacking, literally felt like they were attacking us for like what we were the bad people, and doing bad things. And we were literally, we were like putting $150,000 into this home, like making it nice.
And it's such a perfect example of, the regulations, whether it's the regulations themselves or the people that are enforcing it they are antagonistic to creating more housing.
They are entitled, and they feel like they have power, and it's their fiefdom that they have total control over. Well, and they are the guardians of the historic feel and charm to the neighborhood.
And they are imagining things that aren't happening but could, like a slippery slope. Like you replace that door, next thing I know, you're painting polka dots on your house. It's going to be like that book, The Great Orange Splot, and we cannot have that.
I mean, man, I've got like a list of things about that. And so like, I'm not doing deals.
Yeah.
So, okay, Matt.
That's a good close right there.
Okay, yeah. Matt, this is a great episode. Again, the loan maturities report is coming out today. So if you haven't already gone over to greatcapitalllc.com/report, do that right now. Download the report. Let us know what you think. Make sure you're signed up for the webinar. It's going to be on October 12th. If you're watching this after that day, well, just look on our YouTube channel. It's there. And while you're there, you might as well subscribe. Just press this subscribe button right now. And if you've watched the end of this video, we really appreciate it. Just do us a big favor and just press the like button. And if you have any comments on any of this, let us know down below. We will do our best. We'll do another episode. We'll review the comments here soon.
Yeah, if I got Minneapolis wrong, feel free to burn me. I'm here to learn. I don't even care if I'm wrong.
Matt, that's the mindset that we have to have. And I think that's what we have every day.
I'm never wrong, but if I was, it wouldn't be the end of the world.
Okay, well, that's close. That's close. Really appreciate you. And again, greatcapitalllc.com, like and subscribe. Got a lot of other stuff coming out, Matt, so you want to stay tuned. And we've got another podcast, by the way. The whole other deal that it doesn't involve really Matt and I, but it's coming with a similar energy. Katrina Green, the complex.
I'm going to promote the Joe Powell episode.
Yeah.
She introduces him as Jay Powell, which is also fun.
I know.
But lots of great stories. And I know it's already running long, but Griffin was talking about, what if investors say, what happens after I give you the money?
Yeah.
And what is that's what the complex is. It's like, and Joe, in Joe's episode, he's talking so much about, with the right knowledge and the right people that are kind of willing to learn, managing the people and like drawing on your own knowledge is the difference between like a $3 replacement part or a $3,000 complete replacement.
Oh yeah, no, I love talking to Joe because, especially on HVAC stuff, because, the whole HVAC industry is, it's sales driven. They're trying to sell, they don't make that money in repairs. So they're trying to, they're selling new systems, and like most people aren't HVAC experts. And so when a guy comes in and takes a look at it and he's like, this thing's on its last, it's like the same, they say the same thing. It's like, this thing's on its last leg, maybe you get another couple months out of it, but it's going to die. Like it's done. Like, you got to replace it. And all of a sudden you're looking at, $5,000, $9,000 thing. And so often it can be like fixed with like one part, like it's like a $3 part. Like it jokes.
I was just like looking. I got like sucked into the podcast just listening to Joe tell stories, and like he runs into so many different scenarios, and just his experience has led him to be able to figure these things out pretty quickly and have and also realize like actually this is what you got to watch out for. And there's and he was one of his examples, like there's a type of employee, maybe you ask him to do something, he'll drag his feet and then he maybe not even do it. Then there's another employee who will be working hard to really dive into fixing this thing, but he's spending all of his time like taking it apart, and like he's spending too much time on it. So you have to figure out, the best way to efficiently use the time, and they could be gung-ho about it, but
working hard, working smart, working hard. There's a wide spectrum, and that's not even unique to maintenance. That's like
for sure.
Those labels are across a lot of folks, a lot of industries. Fascinating. So check out the complex. Great episode. You go take a listen. Tell us what you think. Catch you next week. Download the report. And we'll see you next time.